Good morning and welcome to this Wednesday, November 2nd, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, it's Fed Day. Of course, the Fed meeting started yesterday, and it culminates today with a policy statement due out at 2 p.m. Eastern. I'm not going to say it's the most volatile time for the stock market, but it can be the most volatile time for the stock market. I think there's going to be a lot of folks listening in on this one to see if the Fed makes any comments whatsoever about perhaps pausing its rate hike campaign, or maybe just looking for words from the Fed that all these rate hikes are starting to work, that they're seeing evidence, proof that this is slowing inflation, anything like that. The market doesn't necessarily need to hear the Fed say they're stopping rate hikes, but they need to hear something that there's been progress made and that they feel like they're getting it under control, whatever that might be. Will it happen? I don't know. I mean, I'm kind of looking at today like, early February in the winter when you're waiting to see if the sun comes up, and whether, was it Puxatawny Phil comes out of the hole, whether he sees a shadow. That's kind of what I'm looking at the market at right now. I mean, looking at the Fed, what are they going to do? Are they going to forecast 6 more weeks of bad market conditions? Or are we going to see perhaps some of the initial signs from the Fed that their campaign is coming to an end, or at least there's an end in sight? And I think if the market gets that, I'm watching the 10-year Treasury yield. We'll look at that in just a minute. But those are the types of things I think are going to be really important today. How does the bond market react to what the Fed has to say? I think everybody pretty much knows that we're going to get a 75 basis point hike. So it's not really the number that matters. It's what they say about the next meeting. Is it going to be 50? Are they going to be more data dependent? Are they not sure what they're going to do? Any kind of uncertainty, like, hey, you know what? We're starting to see some signs that maybe we need to ease. Anything like that, I think, would be good for both the yield coming down and then also the stock market. Let's go ahead and before we get things started, let me go ahead and share my screen with you. So for those of you who are new to Earnings Beats, first of all, welcome. Really appreciate you tuning in. And I want to thank all of those who've been loyal supporters of mine and Earnings Beats over the years, whether it be here on these shows, whether it's over at Stock Charts. If you're members of Earnings Beats, we want to really thank you for that. But for those of you who are new and maybe don't know much about us, if you go to earningsbeats.com, we do try to give back quite a bit. I'll give you 2 perfect examples. One, coming up this Saturday, we are doing a free virtual event. I study the market. I don't want to say like no other, but I'll tell you, if there's somebody out there that studies more than I do, I'd like to maybe meet them and talk a little bit about what they've found, because I spend a lot of time researching. This is a hobby of mine more than it is a job. I love the stock market, and I have seen so much manipulation. I study bear markets. I try to figure out what makes them tick. When should we really be worried? When should we just be cautious, but feeling like, hey, this isn't going to last? And I'm going to uncover a lot of these things in this Understanding Market Manipulation webinar. It's a free virtual event. It's this Saturday, November 5th, 10 a.m. If you really want to learn some things about the stock market, not just on CNBC bringing in a guest, oh, I think this group's going to go higher, I think this group's going to go lower. Meanwhile, their financial firms are back, either buying or selling in their market making. I mean, you don't know what's going on. There's so much conflict of interest in the big Wall Street firms. I don't know what you can trust and what you can't. I'm going to give you things that no one on CNBC is talking about. And so if you want to come in and learn some things about the stock market and what really and truly makes the stock market tick, you want to be in there for this event coming up on Saturday. Again, 10 a.m. Register. Even if you can't make it, we'll send out recordings. So you want to make sure you're registered so that you get copies of the recordings, even if you can't attend. Very important. Hard to say how long it's going to last. I mean, I'm going to go until I run out of things to say. I'm not going to skimp. I'm going to talk about the things I think that are really important that you need to know. My guess is it's probably going to be 90 minutes. Maybe it could be a couple hours. But again, if you can't stay for the whole thing, we'll get you the recording. You just want to make sure that you are up to speed on what's going on Wall Street. The other thing is, even if you're not interested in that event, we do have a free newsletter that comes out 3 times a week. That's our Earnings Beats Digest. Again, free. No credit card required. The event this Saturday, no credit card required. With the newsletter, you can unsubscribe at any time, 3 times a week. I do it in my own time to provide charts I think that will help folks better understand the market, maybe provide trading opportunities if that's what you decide to do with it. Of course, that's completely up to you. But 3 times a week, Mondays, Wednesdays, Fridays, they're normally out around 8:30, about an hour before the market opens. A very quick read. 2 paragraphs in a chart. That's all it is. So anyhow, if you'd like to subscribe, make sure you sign up there. All right. Let's go ahead and take a look, though, what happened yesterday. We got a gap up. Things looked pretty good. And then we came down very quickly. Again, it was morning selling and then mostly sideways action the rest of the day. Although, I try to be objective. NASDAQ yesterday did see more selling intraday. It was just one day, but it did see more selling intraday. I'm sure a lot of that had to do with the market, many market participants getting a little bit more defensive ahead of this meeting. I don't blame them. I'm not sure what the Fed's going to say at 2 o'clock today. I wish I knew. I think it would certainly help in my conviction one way or the other in the market. But we know that the Fed, while usually a friend of the stock market, because they're trying to maximize employment, that's one of the things that they do. That's one of their mandates. And of course, if you're trying to maximize employment, that's going to probably be a good thing for the stock market. A lot of folks think the Fed's just doing things for the stock market. Well, they are, but it's more of an indirect benefit. They're trying to maximize employment. They're trying to stabilize prices. Those are the 2 major mandates. And right now, they're trying harder to stabilize prices than they are to maximize employment. And so they're not being very friendly to the stock market because, again, they're doing their job or what they perceive to be their job. But as we approach this, I can tell you that if you look at the S&P 500, we'll look at a bigger chart here shortly. Right at the end of August, you see this big drop? That was the Jackson Hole speech. That's where Fed Chief Powell said we have more pain ahead. We were in the midst of an uptrend. I honestly thought that June low was it. We were trending higher. Everything looked good. And I think the Fed threw the market a curveball saying, no, you don't understand. There's more pain ahead. We got things. We're not ready to give in here. And at that point, market made another push to the downside. That big move right there was the Fed. This next big gap down here in September, that was the August CPI report when it came out hotter than expected. Inflation data. Move on to the next month. You see this big gap down right here and then recovery. And by the way, I had an email probably a week or 2 ago saying that my charts were messed up because it's not showing hollow candles. It's because it's so scrunched up. These black candles, many of these black candles, maybe all of them are hollow candles. I guess they don't have to all be hollow candles, but many of them are. Anyway, here in October, the S&P 500, when we had the big gap down and the huge rally, that gap down was because of the September CPI report. Next Thursday, we will get the October CPI report. Today, we're going to get the Fed announcement. These have been 2 thorns in the side of the bulls. So I don't blame folks for moving a little bit more defensively yesterday. We saw that. We saw the big gap down in the yield, and then it came roaring back because everybody on that was an opportunity for those that were in bonds and have been running, have been doing well to effectively get out. Because we had the yield going down. When the yield's going down, it means bond prices are going up. So yesterday on that gap down, bond prices were at the highest they've been in a while. So if you're trading bonds, it's a great time to take some profits ahead of the Fed meeting. And we saw that all day long. The problem is that it also impacts the stock market, because when rates are going up like that, typically you're going to see the more growth-oriented stocks sell off. And that's what we saw with the NASDAQ. Just a little bit more relative underperformance. The NASDAQ got off to a pretty good start yesterday, leading both the Dow and the S&P. But by the time the day ended, look at the NASDAQ down 0.9%, the S&P 500 down 0.4%, and the Dow Jones Industrials down about 0.25%. So definitely flipped the table a little bit on the NASDAQ yesterday with that intraday move higher in the yield. Mid caps actually rose 0.4%, small caps slightly more than that on a percentage basis. Looking at the sectors, energy, the winner again. Energy's been on a roll. Utilities, and by the way, you might be saying, well, why is energy going up? Crude oil prices aren't exactly flying. We've been moving back up again, but still beneath $90 a barrel, nowhere near where we were the last time that energy got up to this level. Well, just remember, energy is more than just crude oil. It needs crude oil to be at certain levels in most cases for these oil companies to make money. But once oil prices are up to a certain level, energy companies can make good money. And I think that's just simply what we're seeing here. As crude oil prices have moved back up from the 70s per barrel up into the upper 80s, it's just a signal that these energy companies are likely to turn some nice profits. And so when you look at technology and consumer discretionary and some of these other areas that have been so weak and their forecasts have been so weak, it's easy to see money rotating and continuing to move back into the energy. And right now, energy is set up really nice. 20-day test would be buyable, any kind of a pullback. But the configuration here with price action above the 20, which is above the 50, and the PPO moving straight up, AD line near 52-week high. Energy looks good. Utilities also up yesterday, up about 0.4%, not looking nearly as good as energy, but we are back above the 20-day moving average, which is good. The three worst sectors yesterday, if you're stock market bull, this is generally what you don't want to see: discretionary, technology, communication services. Now, we did finish down for the day yesterday, so it's not unusual to see aggressive groups down, but it was the way that we went down. We had gap ups at the open, and then we had selling all day long for the most part, mostly in the morning, but it continued even into the afternoon, just at a lesser pace. So we'll see. I don't know what's going to happen with the Fed. I think this is going to be a major wild card. I do think we're getting much closer to the end of these hikes than we are the beginning, but whether or not that translates into a big rally after the Fed announcement, I don't know. We're going to find out together. 10-year Treasury yield. So let me get an update, show you where we are right now. We're 4.04, which is really pretty close to where we finished yesterday. Let's see if we inspect. You can see yesterday we closed at 4.052. Now we're at 4.042. So we're down 1 basis point. But here was the recent peak, and here's the yield coming down. Now, if you want to see that, this is the yield. Now, that's, if you buy bonds, you're not going down. The yield's going down, but bond prices are going up. If we look at the TLT, this is the 20-year Treasury bond, and this is the rally. So for those who have been shorting the TLT, this could be just a little bit of short covering. For those who are trying to pick a bottom, looking just because we're oversold, looks like, hey, we're getting a little bit of a rebound here. So this is an opportunity. When we gapped up yesterday, that's what I was talking about. It's an opportunity for folks to sell bonds and yields to go higher. So let's look at that on an intraday basis and see what that looks like. So here was the gap up, right back up near the highs, and then the selling kicked in. All right. Now, if we pull up the 10-year Treasury yield, you'll see the opposite. You see the big gap down. Treasury prices go up, the yields go down. So as the sell-off begins in Treasury prices, then you see the yield coming back up. Always, always, always a 100% inverse relationship. If you know what the price of bonds is going to do, then you're going to know what the yield's going to do, or vice versa. So we're going to see what happens, but this is going to be an interesting chart to watch at 2 p.m. See what happens to the yield, and also we'll see what happens to the stock market as well. And while we're looking at this intraday chart, this is a 5-day, 10-minute chart. Here was the S&P yesterday. Look where we got to, 39.12. We had closed 2 days ago, 39.01, came back down a little bit below 3,900. If you've been watching the show, or if you've been watching the charts, you know S&P 500, 3,900 has been a big level, both as support and resistance for the past 5 months. So here we gap up above 3,900, things look good, and market gets slammed. By 11 o'clock, we reach the low of the day, or pretty close to the low of the day, straight down selling. Look, 2 days ago, we actually gapped down just a tad, and then look what happened for the first 90 minutes. We went up. Of course, we kept going up, but now we're kind of right back in the middle of that range of that trend day. Again, we'll see what happens this afternoon, but it could be fireworks for sure. All right, let's move on to the S&P 500. Here was that gap up, and for those of you maybe that are new to the show and not really understanding this 3,900 impact, I want to just show you. This is one of the coolest things, one of the coolest annotation features over at Stock Charts. It's this price support resistance line. And all you have to do is just go in here where you see this line, and then just go down to auto support resistance, click on that. And then you can literally drop these lines wherever you want. I'm just clicking, and I'm finding some key levels. Here was a big low at 4,100. Here was a top over here at 4,100. And then 41 to 42. I mean, you could maybe even draw like in here a little range. There was a lot of tops and bottoms that came in through around that area. But 3,900, look at these lows. The gap down right here was from 3,900. Here we got just slightly above 3,900, failed, went through 3,900, tested it. I talked about this many, many times, but again, I always like to go over things for those who maybe weren't at the last show or the last several shows where I've probably talked about this. But here we go back down below 3,900 mid-September, went back, established a new low, and now here we are back at 3,900. And when we had that positive divergence form, higher PPO, lower price, that's when I talked about a 50-period test. And at the time when this printed, the 50 period was up here at about 39.50. And so what I was talking about was, hey, this is going to keep dropping. Maybe we get back up and have another 3,900 test. And that's where we are. I think this is a big level on a lot of different fronts. I think this is an opportunity for either the Fed to make the statement that, hey, things are improving. We're going to become much more data dependent. We're seeing some positive signs. I don't know if they're going to take that tact, or if they really and truly don't want the stock market to come back up, because the stock market, a stronger stock market, encourages folks to spend. You feel better if you have 401ks, or if you invest in the market and have a portfolio. As that goes up, it makes you feel wealthier. Psychologically, you'll spend money. And so one thing that stock market can do for the Fed is a bad stock market can help cut spending, which in turn cuts demand, which in turn lessens inflation pressures. So there are plenty out there who believe the Fed wants the stock market to crash. Now, I don't believe they want the market to crash. I think they want a soft landing. Crashing means jobs. I mean, we'll talk about some massive unemployment if the stock market were to crash. I don't think we're looking at that. And when I talk on Saturday and I go over some of the manipulation, you'll understand one of the reasons why I don't believe that's going to happen. But anyway, watch 3,900 with the Fed meeting after the announcement. If we could make a big move back up through 3,900, I think that would be big. On the flip side, S&P 500, watch the 20-day moving average. Are we trending higher? We've gotten through the 50, the PPO's turned positive. Things are looking pretty good. If we're trending higher, the rising 20-day moving average tends to be a very solid support level. So watch that to the downside. If that fails, then I think we're opening back up to 3,500, 3,600. So it truly is going to be a big day, and this reaction is going to be important to watch. All right. I want to talk a little bit about earnings, because between today and tomorrow, these are the two heaviest back-to-back earnings days of the quarter. Now, we don't have every earnings report on this list because some companies simply don't have, we're looking at companies with market caps over 1 billion. So if you're not over 1 billion, you're not going to be on our list. So there are a lot of companies that are not on here. But if we just pull this up, this is for all the companies. And we do this, by the way, and include a link in our free newsletter that you can get these chart lists. The one I'm looking at right here that has every company, this is every company over 1 billion market cap that reported their results after the close on Monday, or before the close, or before the open, I should say, on Tuesday. So from the Monday close to the Tuesday open, these are all the companies that reported earnings. So when that stock market opened yesterday, these companies were opening with new fundamental information. And so this is, I think, the best way to quickly look at which companies benefited, which companies got positive reactions from earnings, and which ones didn't, all in one chart list. We do this out of the kindness of our hearts. I've got folks here at Earnings Beats that work with me. They work hard putting these things together, and we do it to help you. If you like to trade earnings, my gosh, I don't know that there's a better tool or chart list out there than what we offer, and it's free. Anyway, there's a lot of different ways to look at this chart list. Right now, we have it numbered. So I've got it in number order, 0001, 0002. What this is, the ones that start with 000 are companies that reported after the bell on Monday. The ones that start with 1,000 are the ones that reported in the morning on November 1st. So that's how you can distinguish whether they reported the night before or the morning of the market open. And again, they're in order of market cap. The couple things you can do with this list. Number one, Scooter score. This is the stock chart's technical rank. If you include that on your chart list, and if you don't see it for some reason, all you have to do is click columns and list or delist whichever column you want. So if I didn't want Scooter, I could uncheck it. And then I come back here and it's gone. But I want it. I want the Scooter. So let's put that back up there. So with the Scooter, again, stock chart's technical rank. It's a formula developed by John Murphy. You can go over to Chart School, read all about it. There's your Chart School link. All you have to do is just type in search box when you get over there. Type in stock chart's technical rank. You'll get articles. Anyhow, I can sort this. So this gives me the best Scooter scores. Now, this one's saying 99, but it probably wasn't before yesterday. The reason it's 99 is because it went up 50% yesterday. And it wasn't just based on earnings. Johnson & Johnson announced they were going to buy the company for, I think, over $17 billion for cash. So a Biomed immediately traded up to that level, which was basically a 50% premium that Johnson & Johnson was offering. So anyway, that's this is in order of Scooter score. And you can kind of just look and see many of these stocks with Scooter scores that are up in the 90s did pretty well. There are a couple exceptions. Harmonic down 10%. That one would be an interesting one for me to look at, because if it's got a 95 Scooter score, which is pretty high, and they beat on their top and bottom line, this could just simply be a buy on rumor, sell on news kind of a situation. So if we look at the chart, I mean, look at this. That's exactly what I think we're getting here. Now, it's gone up a lot. I think this breakout occurred at 12. You got the 50-day moving average at 1260. This stock was just 1575 yesterday, 1580. You might start buying small pieces of it. I mean, that's completely up to you, and it's your money. So do what you want. But these are the types of things that I like looking at a company like HLIT. Now, I actually bought Eli Lilly yesterday. Look at the gap down. This stock had just broken out above all this consolidation. The AD line looks great. Lilly, relative to the pharmaceuticals, it's been one of the strongest pharmaceutical stocks. Pharmas have been rising versus the S&P 500 now for the last 2.5 months. So it's a strong group, and this is a strong stock within the group. Lilly beat revenue estimates, beat its quarterly earnings estimates, and the stock went down. And I'm pretty sure I talked about this yesterday morning on my show, that if this stock went down and hit its 20-day moving average, it was a buy. Well, it went down, hit its 20-day moving average, and I bought. Now, it went back up pretty quickly, and I actually just took the profit and walked away from it because, again, don't know what's going to happen with today and going forward. But I used this earnings information to place trades a lot of times. And so I like these stocks that are really strong stocks. They come out, and again, I don't know if Harmonic beat top and bottom line, but if they did, this could simply be buy on rumor, sell on news. All the people that have been chasing Harmonic at the end are going to panic and sell. Probably some of them did yesterday. And if this goes down to the 50-day, I can promise you anybody who bought back at 15.5, that 1 or 2 days later sees 12.5, is going to think, oh my gosh, I got to get out of this thing. I'm losing a fortune. That's how market makers can accumulate shares cheaper. Do you think if there's an institutional client that wants a couple 100,000 shares of the stock, they want to buy after the huge rally? No. They want to buy on these pullbacks. They want market makers to accumulate shares for them on these pullbacks. So that's what you have to kind of keep in mind as you look at these reports. But then if we hit the scooter again, you can see the ones that have not, have had very low scooter scores, and look at how they reacted to their earnings. Almost every one of them down. Now, again, these big ones, maybe their scooter scores could have been higher prior to their earnings. They may have jumped way down because they got hit so hard. But some of these others are just down a little bit. But you can see almost every single one of them that has a low scooter score went down after their earnings report. So here's today. These are the, actually, that's not the, well, this will be tonight and tomorrow. So this will be after the bell today and before the bell tomorrow. And then this one will be after the bell tomorrow and before the opening bell on Friday. So those will be those two. But then I also have this one, and we'll do view all, summary. And here it's in that scooter order, but let's get it in name order. So these are all the companies that just reported last night or this morning. And AMD, we're going to come back to this one in a couple minutes because the market's about to open. So we're going to go just a few minutes later so that I can just show you on a live chart how you can quickly look at all the companies that just reported. So we'll come back to this in just a minute. But as I look to the ones that are going to be reporting tomorrow, you can start doing your homework. Sort it in scooter order. This is before the earnings come out. Which of these companies, are looking good heading into earnings? And then after you sort it by scooter, what you might do is sort it by sector. So now what it will do is if you go to discretionary, it sorts all the discretionary in scooter order. So maybe you like discretionary stocks. I can tell you the ones I like are the energy, industrials, and financials. Here are financials. These insurance companies have been really strong. So I'm paying particular attention to these insurance companies. If they pull back after their earnings, if they post good numbers and they beat and they pull back, they're going to be opportunities. I want to give you a company that I gave to our members a couple of times recently, W.R. Berkley. So this is in the insurance area. Look what this company did after earnings. So it had a strong AD line. It was a strong relative performer versus its peers. Look at the insurance group relative to the S&P 500 going up. Strong stock in a strong group. And after earnings came out, it gapped down and went down to the 20-day moving average. Look what it's done since. 5 straight days up. This thing got down to under $68 a little over a week ago. You could get into a leader. Now it's at 75. That's why when I'm looking at these, looking at these various companies, how I want to look at them to kind of get a sense of, which ones have been outperforming. See if they're insurance. And another way you can do this, here's property casualty insurance. That's PLMR. Another thing you can do is just type in insurance in the box. And you can look at all the insurance companies that basically are in scooter order. So you know which ones are getting ready to report that have strong scooter scores. These are companies that you might be interested in. We've done all the research for you. We've put everything together. All right. So anyway, the market is now open. So what I'm going to do is come back here and I'm going to refresh. Can do this. Let's do this refresh. And there's your big winner today right now, Chegg. So I can quickly, of all the companies that reported since yesterday at the close that have market caps of at least 1 billion, Chegg's the best performer. I knew that in an instant just by pulling up this chart list. So click on the chart. Well, gapped up, but it's been going sideways. Hasn't really been a big leader. It is in the specialized consumer services group, which is breaking out now to a 52-week relative high. So this is the best the group has performed versus the S&P 500 in the last year. So that's a positive. Would I chase it? No, I wouldn't do anything with this one yet, because if it was a leader and it gapped up like this and maybe pulled back, maybe as it got close to 24, I would start nibbling. And if it got all the way back down to maybe 21, 22, down 22, I would probably be filling out a position. This would be one I'd keep on a radar. And you can use you can set alerts at stock charts. If you see a stock that you really like, go in and set an alert and say, hey, if CHGG hits $23, send me an email or send me a text. That's a great service that Stock Charts has. You can put all of this together, even if you're working full time. Send an SMS message to your phone. You don't have to stand in front of your computer. Let's see, what else? Match. I know they had beaten, I did see headlines where they had beaten their subscription estimates. But you can kind of look down the list and see which ones are doing best and then flip it. Which ones aren't doing so well? And I like to look sometimes at the sectors too. So medical equipment hasn't been a great area of the market. Industrial suppliers hasn't been bad. And look, ENVX had a 93 scooter and it's down 30. Now 30% is pretty huge, but 30% is a lot. Let's take a quick look here. I'm looking to see if there's any kind of support level. This is one where it gaps down with really big volume already. Sometimes one thing I would do, I've used this strategy before. Today's open was at 1341. We don't know how far it's going to go down, but as it goes down and everybody sells, market makers are buying. So a lot of times what I'll do is wait. And if the stock turns back around and breaks back above the open, sometimes I'll set a stop buy there. In other words, I'll buy the stock. Now, I want to see what their earnings were. If they had a big miss or something, then no, I'm not interested. But if they beat and I don't know, maybe they offered up something that, said inflation is crimping supplies or I don't know, something future, they beat, but maybe they said something bad about the future. I think that could be an opportunity to accumulate in an area where the market's been pretty good. Here's the industrial supplier group. That's what I was talking about. So this has been a Not so great stock. It's been pulling back recently, but it's in a great area. If I can get a stock in a great area that's also in an uptrend versus that area, then on that, those pullbacks are really important to me. Anyway, I just wanted to show you this market's open now. It's been open 5 minutes, and this is where we currently stand. Here's a hotel and resort, 75 scooter. Before that 15% drop, though, maybe it was 90. I'm not sure. ATI in the steel area down 10%. So a lot of times what I'll do is I'll look for high scooters among stocks that are dropping and then flip it. And I'll look for low scooters on some that are up, like Match. May not last. If you like to short, sometimes shorting a stock that's been very weak into an earnings report can be a short-term win. But I would suggest, if you're not familiar with this and never done that before, maybe doing some paper trading for a while. But we make it easy for you. We give you all the information. All right, let's head out or back to the main page here and wrap this thing up. Currently, NASDAQ down 36, S&P down 12, Dow down 80. All of them roughly the same percentage. We got the VIX back up above 26. I'll tell you, the VIX has been pretty low considering. Of course, the market's, rallied, sending the VIX back down. But, the bears need the VIX to take out 35, 36. And here we are down at 26. There's a lot of work to be done. A lot of fear has come out of the market. And so I just don't think the VIX is going back to 35, 36. I don't think the stock market's going back to a new low. But 2 p.m. today could change all that. The Fed definitely has that kind of power. If Powell decides, hey, we need that market down, and hey, we got more pain ahead. If he goes into that mode, all bets are off. We're going to find out 2 o'clock this afternoon. All right, tomorrow I'll be back over at Stock Charts TV, so you can click on this link right here at 9 a.m. tomorrow if you'd like to listen into the next show. That airs at 9 a.m. Eastern time. So again, 9 o'clock, head over to Stock Charts, click on that, and you can join in. Everybody have a great day. Be careful with the Fed. Usually the volatility from 2 to 4 can be extreme. It was crazy last month. It can be extreme. Just be on your toes from a trading perspective. Everybody have a great day. Happy trading.